A lot of the material in this lecture has been taken from the curriculum. I will emphasize the content that I believe has the highest probability of being tested. Here is what we will cover. Goals of the GIPS Executive Committee, key features of the GIPS standards, historical performance record, compliance, implementing a global standard, and then the 9 major sections of the GIPS standards. We will focus on fundamentals of compliance. This is required at level 1. The other sections, we just need to know them at a high level. And finally, we will look at a sample GIPS compliant presentation. Goals of the GIPS Executive Committee. It would be useful to learn this list. The first goal is to establish investment industry best practices for calculating and presenting investment performance that promote investor interests and instill investor confidence. Number 2, to obtain a worldwide acceptance of a single standard for the calculation and presentation of investment performance based on the principles of fair representation and full disclosure. With increasing globalization, this is becoming extremely important. An investor sitting in Germany, for example, might be considering investment opportunities in various parts of the world. And it is extremely helpful if investment management firms in Asia, North America, South America, Europe, etc. are following the same standard when reporting their performance numbers. So that's where this comes in. Number 3, to promote the use of accurate and consistent investment performance data. To use a simple example that we also see in the quantitative methods part of this course, when an investment management firm calculates return numbers, there are different ways of calculating the return numbers. For example, either the time-weighted rate of return can be used or the money-weighted rate of return can be used. Obviously, if different return methods are being used, then we cannot compare those numbers. If firms are following the same standards, then they will use the same calculations and it will become easier then to compare numbers. Next one, to encourage fair global competition among investment firms without creating barriers to entry. A common standard helps to level the playing field, and that's why by using a common standard that encourages fair competition across the world. To foster the notion of industry self-regulation on a global basis. If investment management firms around the world are on their own complying to a particular standard, then that clearly is self-regulation, which is good for the industry. Key features of the GIPS standards. The GIPS standards are ethical standards for investment performance presentation to ensure fair representation and full disclosure of investment performance. In order to claim compliance, firms must adhere to the requirements included in the GIPS standards. Notice the term ethical standards. GIPS, in a sense, connects back with some of the standards that you study in ethics under the code and standards. Obviously, the code and standards make a general remark that the presentation should be fair and accurate. The GIPS standards give a lot more detail on how the performance presentation should be made. Key feature number 2, meeting the objectives of fair representation and full disclosure is likely to require more than simply adhering to the minimum requirements of the GIPS standards. Firms should also adhere to the recommendations to achieve best practice in the calculation and presentation of performance. So the important point here is that we have both requirements and recommendations, and these recommendations ideally should be followed. Number 3. The GIPS standards require firms to include all actual discretionary fee-paying portfolios in at least one composite defined by investment mandate, objective, or strategy in order to prevent firms from cherry-picking their best performance. Connecting this back with something we saw in the earlier reading, firms should define composites, and then every actual discretionary fee-paying portfolio needs to be in at least one of the composites. This is because performance numbers are reported on a composite basis. If a particular portfolio is not included in any composite, then the returns associated with that particular portfolio will not be presented. Number 4. The GIPS standards rely on the integrity of input data. The accuracy of input data is critical to the accuracy of the performance presentation. The underlying valuations of portfolio holdings drive the portfolio's performance. It is essential for these and other inputs to be accurate. The GIPS standards require firms to adhere to certain calculation methodologies and to make specific disclosures along with the firm's performance. Number 5, firms must comply with all requirements of the GIPS standards. And again, we've seen this before. Either a firm complies with all GIPS requirements and then can make a claim that it is GIPS compliant. If a firm does not comply with all standards, even if it doesn't comply with one substandard, it cannot claim GIPS compliance. Historical performance record. A firm is required to initially present, at a minimum, 5 years of annual investment performance that is compliant with the GIPS standards. If the firm or the composite has been in existence less than 5 years, the firm must present performance since the firm's inception or the composite inception date. After a firm presents a minimum of 5 years of GIPS compliant performance, the firm must present an additional year of performance each year, building up to a minimum of 10 years of GIPS compliant performance. Let's make sure we understand this. If a firm decides that it wants to become GIPS compliant and the firm has been in existence for 3 years, then the firm needs to present GIPS compliant performance numbers for the last 3 years, and then every year after that it adds performance numbers. If the firm has been in existence for, let's say, 12 years, then the firm needs to present initially a minimum of 5 years of annual investment performance. So even though the firm has been around for longer, when the firm decides to become GIPS compliant, it needs to present numbers for the last year and basically go back 5 years. After that, over time, the firm keeps adding performance numbers for each year until there is a total of 10 years worth of performance data. Once a firm has 10 years worth of data, then it is optional to present data from time periods before this. Firms may link non-GIPS compliant performance to their GIPS compliant performance, provided that only GIPS compliant performance is presented for periods after 1st January 2000 and the firm discloses the periods of non-compliance. Firms must not link non-GIPS compliant performance for periods beginning on or after 1st January 2000 to their GIPS compliant performance. This means that, let's say a company is presenting information in 2014 and it wants to present information for the last 20 years. Obviously, it will then have to present some information from the 1990s. The performance numbers from the 1990s can be non-GIPS compliant. But let's say that if the data from 96 to 99 is non-GIPS compliant, then it needs to be clearly disclosed that these performance numbers are not GIPS compliant. Any performance numbers after 1st January 2000 have to be GIPS compliant. Firms that manage private equity, real estate, and or wrap fee / separately managed accounts called SMAs, these portfolios must also comply with sections 6, 7, and 8 respectively of the provisions of the GIPS standards that became effective as of 1st January 2006. As we'll see later in this presentation, there are some special features associated with these different kinds of investments, and there are particular sections that deal with the special features. So section 6 deals with private equity, 7 deals with real estate, and 8 deals with wrap fee or separately managed accounts. Before moving on to the next slide, I just want to emphasize the two most important points here. One key point is that at least 5 years of performance information needs to be presented initially, and then that needs to build up to at least 10 years. Compliance. Firms must take all steps necessary to ensure that they have satisfied all the requirements of the GIPS standards before claiming compliance. Firms are strongly encouraged to perform periodic internal compliance checks. In other words, once a firm has claimed compliance, it should keep doing these checks to ensure that all the standards, all the provisions are still being followed. Firms may choose to have an independent third-party verification that tests the construction of the firm's composites as well as the firm's policies and procedures as they relate to compliance with the GIPS standards. We've discussed this before. Verification is recommended, but it is voluntary, and if verification is done, it must be done by an independent third party. In addition to verification, firms may also choose to have specifically focused composite testing, also called performance examination, performed by an independent third-party verifier to provide additional assurance regarding a particular composite. So this essentially is getting into a particular composite in a lot more detail. The effective date for the 2010 edition of the GIPS standards is 1st January 2011. Compliant presentations that include performance for periods that begin on or after 1st January 2011 must be prepared in accordance with the 2010 edition of the GIPS standards. Coming now to implementing a global standard. The presence of a local sponsoring organization for investment performance standards is essential for effective implementation and ongoing support of the GIPS standards within a country. GIPS is sponsored by the CFA Institute, and obviously the CFA Institute needs partners or local sponsoring organizations in different parts of the world to help implement GIPS. In Pakistan, for example, the CFA Association of Pakistan is the local sponsor. The curriculum lists local sponsors in other parts of the world. A country sponsor ensures that the country's interests are taken into account as the GIPS standards are developed. Clearly, this is a global standard, so with representatives or local sponsors in different parts of the world who are feeding in issues or concerns related to their country, that allows the global standard to indeed be truly global and take into account the performance related aspects that might be peculiar to particular parts of the world. The GIPS Executive Committee strongly encourages countries without an investment performance standard to promote the GIPS standards as the local standard. And this makes a lot of sense. If in a particular country there is no standard, then it is quite effective to simply follow the GIPS standards, which have been established and are being used in so many other parts of the world. From a testability perspective, this is important. In cases in which laws and/or regulations conflict with the GIPS standards, firms are required to comply with the laws and regulations and make full disclosure of the conflict in the compliant presentation. In other words, the firms can still claim GIPS compliance as long as they make it clear that in this particular area, the law of the land is being followed, which conflicts with the GIPS standard. The structure of the GIPS standards, this has been discussed briefly in the previous reading. What we will do now is focus on Standard 0, Fundamentals of Compliance. This is required. For the remaining standards, what we will do is just go over the descriptions, and that's all you need to know at level 1. Fundamentals of compliance. Several core principles create the foundation for the GIPS standards, including properly defining the firm, providing compliant presentations to all prospective clients, adhering to applicable laws and regulations, and ensuring that information presented is not false or misleading. Two important issues that a firm must consider when becoming compliant with the GIPS standards are the definition of the firm and the firm's definition of discretion. The definition of the firm is the foundation for firm-wide compliance and creates defined boundaries whereby total firm assets can be determined. The firm's definition of discretion establishes criteria to judge which portfolios must be included in a composite and is based on the firm's ability to implement its investment strategy. This point related to discretion was mentioned earlier, where we said that in a composite, only discretionary portfolios should be included. And if we are saying only discretionary portfolios should be included, then clearly we need a definition of discretionary. That is the point being made here. At level 3, we will discuss this particular item in more detail. Let us now look at the specific requirements under Fundamentals of Compliance. Fundamentals of Compliance is provision 0, and this is how the provisions and sub-provisions are numbered. So provision 0 will have sub-provision A.1, A.2, and so on. And I'm actually going to read these with you and then emphasize the ones that I think are most important from a testability perspective. Firms must comply with all the requirements of the GIPS standards, including any updates, guidance statements, interpretations, questions and answers, and clarifications published by CFA Institute and the GIPS Executive Committee, which are available on the GIPS website. Firms must comply with all applicable laws and regulations regarding the calculation and presentation of performance. The point here is that if there are no specific laws and regulations, then GIPS compliant firms must follow the rules specified in the GIPS handbook. If, however, a given country prescribes certain laws about how to report performance, then the country's laws should be followed, and any differences between the country's laws and GIPS need to be documented. Firms must not present performance or performance-related information that is false or misleading. The GIPS standards must be applied on a firm-wide basis. Firms must document their policies and procedures used in establishing and maintaining compliance with the GIPS standards, including ensuring the existence and ownership of client assets, and must apply them consistently. If the firm does not meet all the requirements of the GIPS standards, the firm must not represent or state that it is in compliance with the global investment performance standard except for so and so, or make any other statements that may indicate partial compliance with the GIPS standards. Statements referring to the calculation methodology as being in accordance with or in compliance or consistent with GIPS are strictly prohibited. Statements referring to the performance of a single existing client portfolio as being calculated in accordance with GIPS are prohibited, except when a GIPS compliant firm reports the performance of an individual client's portfolio to the client. Firms must make every reasonable effort to provide compliant presentation to all prospective clients. Firms must not choose to whom they present a compliant presentation. As long as a prospective client has received a compliant presentation within the previous 12 months, the firm has met this requirement. Firms must provide a complete list of composite descriptions to any prospective client that makes such a request. Firms must include terminated composites on the firm's list of composite descriptions for at least 5 years after the composite termination date. Two important points here. I have talked earlier about the definition of a composite, and I took a very simple scenario where I said that for a particular composite, we are only including portfolios that are equity-based portfolios and where our stocks are growth stocks. So this would be one simple definition. At level 3, we'll talk about these definitions in more detail. Also, the fact that even if a composite has been discontinued, the numbers still need to be reported as long as the composite was discontinued over the last 5 years. This clause is there to deal with the survivorship bias issue that we have also talked about. Firms must provide a compliant presentation for any composite listed on the firm's list of composite descriptions to any prospective client that makes such a request. You keep seeing this term compliant presentation. A compliant presentation is simply a presentation that complies with all the GIPS provisions. And at the end of this lecture, I will show you a sample compliant presentation. This next item is extremely important. Firms must define as an investment firm, subsidiary, or division held out to clients or prospective clients as a distinct business entity. So this gets into the point related to the definition of a firm. So if you have a particular entity, let's say that you have a larger firm called UBL, and under UBL you have a firm called UBL Asset Management. And this particular entity is showcased as a separate investment firm, and those who want to invest their money explicitly approach UBL Asset Management. Then it is appropriate to say that UBL Asset Management is the firm that could potentially be claiming GIPS compliance. For periods beginning on or after 1st January 2011, total firm assets must be the aggregate fair value of all discretionary and non-discretionary assets managed by the firm. This includes both fee-paying and non-fee-paying portfolios. Now, just to avoid any confusion, if let's say a particular firm is reporting its total assets, then it can include all discretionary and non-discretionary assets. This is not to be confused with what needs to be reported within a particular composite. When we are talking about a composite, that will only have portfolios that are discretionary and fee-paying and meet the other criteria that we have talked about. Total firm assets must include assets assigned to a sub-advisor, provided the firm has discretion over the selection of the sub-advisor. So let's say our firm is UBL Asset Management and some of the portfolios are managed by a sub-advisor. So the assets managed by the sub-advisor also fall within the total assets that are reported by UBL Asset Management. Changes in a firm's organization must not lead to alteration of historical composite performance. And finally, when the firm jointly markets with other firms, the firm claiming compliance with the GIPS standards must be sure that it is clearly defined and separate relative to other firms being marketed, and that it is clear which firm is claiming compliance. In terms of recommendations, we only have 4, and you can read these recommendations. The one that I'll emphasize is B.3. Firms should adopt the broadest, most meaningful definition of the firm. The scope of this definition should include all geographical offices operating under the same brand name, regardless of the actual name of the individual investment management company. So notice that this is a recommendation and it is very strongly recommended. The earlier point was a requirement that the firm must be defined as an investment firm or a subsidiary or a division which is held out to clients as a distinct business entity. Now we will talk briefly about the remaining 8 provisions, and as I have mentioned before, these 8 provisions are discussed in detail at level 3. Here you simply need to get a general sense. Input data. Consistency of input data used to calculate performance is critical to effective compliance with the GIPS standards and establishes the foundation for full, fair, and comparable investment performance presentations. For periods beginning on or after 1st January 2011, all portfolios must be valued in accordance with the definition of fair value and the GIPS valuation principles. So the simple summary is that the input data should be good. Otherwise, obviously, the performance numbers which are reported will be meaningless. Calculation methodology. Achieving comparability among investment management firms' performance presentations requires uniformity in methods used to calculate returns. The GIPS standards mandate the use of certain calculation methodologies to facilitate comparability. You don't really need to know this currently or at level 1, but just as a heads up, the method that needs to be used for a regular investment management firm is the time-weighted rate of return. Composite construction. Achieving comparability among investment management firms' performance presentations requires uniformity in methods used to calculate returns. The GIPS provision 3 is composite construction. A composite is an aggregation of one or more portfolios managed in accordance to a similar investment mandate, objective, or strategy. The composite return is the asset-weighted average of the performance of all portfolios in the composite. Creating meaningful composites is essential to the fair presentation, consistency, and comparability of performance over time and among firms. Just to make this point related to the weighted average a little obvious, simplistically, let's say that in a particular composite we have 2 portfolios, portfolio 1 and portfolio 2. Let's say that portfolio 1 has a value of 10 million and portfolio 2 has a value of 90 million. If portfolio 1 had a return of 10% and portfolio 2 had a return of 12%, then when we report the overall return for this composite, the 12% return should have a 90% weightage. So the overall return for the composite will be much closer to 12% than to 10%. Disclosure. Disclosures allow firms to elaborate on the data provided in the presentation and give the reader the proper context in which to understand the performance. To comply with the GIPS standards, firms must disclose certain information in all compliant presentations regarding their performance and the policies adopted by the firm. Although some disclosures are required for all firms, others are specific to certain circumstances and may not be applicable in all situations. Firms are not required to make negative assurance disclosures. Example, if the firm does not use leverage in a particular composite strategy, no disclosure of the use of leverage is required. One of the essential disclosures for every firm is the claim of compliance. Once a firm meets all the requirements of the GIPS standards, it must appropriately use the claim of compliance to indicate compliance with the GIPS standards. The 2010 edition of the GIPS standards includes a revised compliance statement that indicates if the firm has or has not been verified. Number 5, presentation and reporting. After constructing the composites, gathering the input data, calculating returns, and determining the necessary disclosures, the firm must incorporate this information in presentations based on the requirements in the GIPS standards for presenting investment performance. No finite set of requirements can cover all potential situations or anticipate future developments in industry, structure, technology, products, or practices. When appropriate, firms have the responsibility to include in GIPS compliant presentations information not addressed by the GIPS standards. In other words, when a firm is presenting information and it believes that some performance related information will be very helpful to investors, then that information should be presented even though it might not explicitly be mentioned in the GIPS standards. Number 6, real estate. Unless otherwise noted, this section supplements all of the requirements and recommended provisions in sections 0 through 5. Real estate provisions were first included in the 2005 edition of the GIPS standards and became effective on 1st January 2006. The 2010 edition of the GIPS standards includes new provisions for closed-end real estate funds. Firms should note that certain provisions of sections 0 through 5 do not apply to real estate investments or are superseded by provisions within section 6. The provisions that do not apply have been noted within section 6. I will not get into any details here because this is something that you will see at level 3. Just a high-level remark is that there might be certain items such as the money-weighted rate of return which would be required for a regular investment management firm that deals in stocks, but for real estate the appropriate measure might be different, and those are the sorts of items that are mentioned in section 6. Private equity. Unless otherwise noted, this section supplements all of the required and recommended provisions in sections 0 through 5. Private equity provisions were first included in the 2005 edition of the GIPS standards and became effective 1st January 2006. Firms should note that certain provisions in sections 0 through 5 do not apply to private equity investment firms or are superseded by provisions within section 7. The provisions that do not apply have been noted in section 7. Again, this sounds a lot like what we just saw in the earlier section. Key point is that if there are certain aspects related to private equity that are very specific to private equity, then those are the items that you will see in section 7. Wrap fee or separately managed account portfolios. Unless otherwise noted, this section supplements all of the required and recommended provisions in sections 0 through 5. Firms should note that certain provisions in sections 0 through 5 of the GIPS standards do not apply to wrap fee or SMA portfolios or are superseded by provisions within section 8. The provisions that do not apply have been noted within section 8. This is an example of a compliant presentation. Notice that you are looking at performance numbers, and up here the composite is mentioned. The performance numbers are at a composite level, and the name of the composite is the balanced growth composite. The data presented is for 10 years. And if you recall, when a firm starts presenting performance numbers based on GIPS, it needs to present numbers for at least 5 years, and then the performance numbers over time have to reach 10 years, and at least 10 years worth of data needs to be presented. So we have 10 years worth of data. For every year, we need to know the composite gross returns, so that's shown over here, the net returns, and then the return of a benchmark. If this particular composite is being compared with a particular benchmark, that benchmark's return should also be shown. This is the number of portfolios in the composite. We'll not worry about internal dispersion. Composite assets, the total assets under management for this composite, and then the total assets under management for the firm. Here you see the compliance claim. So this particular firm claims compliance with the Global Investment Performance Standards and has prepared and presented this report in accordance with the GIPS standards. So this is the only statement that is allowed. Firms cannot paraphrase this or say it in their own words. The handbook explicitly says that if a firm is compliant, then this is what it should say. The next part over here talks about the fact that this particular firm has also been verified. These are the various notes, and I'm not going to read these, but if you go through this, you will see a connection between this material and what we have been talking about. That brings us to the end of this reading. Note that at level 1, readings 3 and 4 are both on GIPS. 3 was an overview, and then 4 got into a little more detail. I have done a lot of reading, so this particular lecture you can actually treat as an audio lecture as well. Listen to it several times because the concept is not difficult at all. You just need to remember several facts. So the most important points being that for a firm to claim GIPS compliant, it needs to be an investment management firm that actually manages assets. Firms can claim GIPS compliance, that's voluntary, but if a firm claims GIPS compliance, it can only do so when it complies with all the requirements. If a firm initially claims GIPS compliance, then it needs to present at least 5 years worth of data, and after that it needs to add performance data for every year up to 10 years. After that, at least 10 years worth of data needs to be presented. Performance is presented at a composite level, and it's important for firms to define the composite. The composites can only contain fee-paying discretionary accounts. Every portfolio that is fee-paying and discretionary needs to be in at least one composite. The definition of a firm is extremely important, and the major point there is that let's say you have a larger entity like UBL, and that holds out a particular entity such as UBL Asset Management as the firm which does asset management. Then even if this firm is operating in different parts of the world, or UBL Asset Management is operating in different parts of the world, then this entity is being held out as the firm. And for GIPS compliance, the GIPS compliance has to be on a firm-wide basis. So those are some of the key points, but obviously you can be tested on anything. So make sure that you go through the lecture several times and also do lots of practice problems. The way you will remember the facts is by doing practice questions, maybe getting a few wrong, but then when you get something wrong, then you remember the fact much better than by simply reading something or by simply listening to a video lecture. That is it. Good luck.